Most people enter the Forex with the wrong picture in their mind. They think Forex is about looking at candlestick patterns, pressing the buy or sell button, and hoping the market moves in their favor. But the truth is much deeper. Behind every movement you see on a chart, there is a battle between currencies, economics, institutions, interest rates, inflations, traders, and billions of pounds flowing from through the global market. A candlestick is not the reason price is moving. It is only a record of what has happened already. The real question every professional trader asks is not, should I buy or sell? The real question is, why is money flowing into this currency and why is it leaving another one? In this lesson, you are going to understand Forex from the foundation, how currencies gain value, why prices changes, and how professionals look beyond the chart to understand forces driving the market. Because once you understand the reason behind movement, the chart stops being mystery to you. Forex is not a chart. Forex is not buying and selling. Forex is not candlesticks. Forex is the global financial system through which the value of one's country money is exchanged from another country money. Most beginners believe Forex is simply pressing the buy or sell button. That is one of the biggest misconceptions in trading. Buying and selling is only the final action. The real Forex market is much cheaper. Let's imagine something. Suppose a businessman in Nigeria wants to import drug parts from China. The Chinese manufacturer does not accept Nigerian naira. They want Chinese yen. How will the Nigerian businessman pay? He must exchange his naira into yen. This exchange is Forex. Now imagine millions of businesses around the world doing this every single day, like the oil companies, the airlines, the governments, the banks, the manufacturers, the tourists, investors, importers, and exporters. Every one of them needs different currencies. That is why Forex exists. Forex was not created for traders. Traders even came later. Forex was created because countries needed to trade with one another. Then what does it Forex really mean? Forex simply means foreign exchange, and foreign means another country's currency. Exchange means swapping one currency for another. For example, when you give someone US dollar, they will give you euro. That is foreign exchange. There's nothing more, there's nothing less. Many beginners think money is just a paper. It isn't. Money itself has value. It's just like gold, just like oil, just like silver, just like wheat. Currencies also have prices. The US dollar has price, the euro has price, and the British pound has a price. The Japanese yen has a price. These prices are constantly changing. So here I'm in the chart so that you understand why I said that currencies have prices. Like this is Euro USD. And let's go down here. You will see that the euro is the base currency pair and the USD is the attacking currency pair. So right now it takes 1.1369 US dollar to buy 1 euro. That means that the euro is actually stronger than the US dollar. So let's go down further. You see that this is BTC, this is Bitcoin USD. It takes 64,797, it changes 64,810 US dollar to buy 1 Bitcoin. Let's go down even further. And here is the US dollar, Nigerian naira. Right now the current price of dollar is, it takes 1,362.76 naira to buy 1 US dollar. That is how the price changes. So this is the base currency, this is the attacking currency. So prices changes every day. As you can see right now, the price of Bitcoin have changed, and that is why if you bought when it was 64810, and now it sits for 815. You are already in profit. That is why they find how the market works. And going here, okay, now this is GBP euro, the British pound versus the euro, and you see that the British pound, it takes 1,170 1.1717 of the euro to buy one British pound. That means the British pound is stronger than the euro. So let's go down a little bit. This is the Japanese yen. This is the US dollar is Japanese yen. So it takes 163.82 Japanese yen to buy one US dollar. Let's go down a bit. And this is the current price of gold in US dollar. If you change the price of gold into pound, it will not be the same as 4,052.600. So if you have 4,052.600 US dollar now, you are going to buy one gold. So now that we know that currencies have price and their price constantly change, the big question is now, why do currency prices changes every time? This is where the real Forex begins. Currencies move because countries are constantly competing economically. Think of every country as a company. Each company wants investors, each company wants customers, each company wants growth. Countries are exactly the same. Countries compete for investment, businesses, jobs, trade, capital, and economic strength. When one country's economy becomes stronger than another, its currency usually becomes more valuable. The forex is a reflection of economics. This is one of the most important lessons in trading. The chart is not creating the movement, the economy is. The chart is simply showing us what has already happened between buyers and sellers around the world. For example, suppose the United States suddenly reports a strong employment, low inflation, and high economic growth. Investment becomes confident. You start investing in America. To invest in America, you will need to buy the US dollar. And the more the buyers, the greater the demand. Then the dollar will become stronger, then the chart will move. The chart didn't create the move, the economy created it. The chart fully recorded what the economy has done. Let me give you an example so that you understand what I'm saying. This is US dollar. This is the consumer price index being released every year by year. So in this year, the previous year, the consumer price index was around 3.37%. So the investors, the traders were expecting price to remain at 3.3%, but it actually came out to be lesser than expected. Guess what will happen? In this case, if the inflation is rising, the federal government is expected to increase the interest rate to attract more foreign investors. But since the inflation is deflating, investors are expecting the federal government to come in and cut rates so that people will be able to borrow more money and they actually make things to create higher demand so that things will go up. So see what happened. The price is going to, US dollar is going to weaken because of the price, the inflation is weakening and government are going to cut rates. So the expectation of these people and cause US dollar is going to depreciate. So let's go to the chart so you understand what I'm saying. So we are on the British pound against the US dollar. So right now, this is on the Friday, 23rd of November, and this candle here represents Tuesday. This candle here represents Monday. This is 13th of November, and here represents the actual day that the news was released. As you can see, since the expectation was for inflation to remain at 3.3%, the US dollar was actually gaining strength little by little until the actual day that the news was released. When investors now find out that the US dollar is actually The inflation, the consumer price index is actually depreciating even more than expected. So they begin to pull out their investment on the US dollar, which created the less demand on the US dollar. And guess what happened? It caused the British pound to appreciate against the US dollar. This does not mean that the British pound has gained power or that the British pound has strengthened. It only means that the US dollar has weakened. So if British pound gains strength and the US dollar becomes weaker, it's gonna cause price the British pound to appreciate. So if the US dollar gains strength against the British pound, it's gonna cause it to depreciate. But if two of them are in the same agreement, price is gonna range just like here. Price was just ranging between here and here. So another mistake beginners make is thinking that the forex market is mathematics or that the forex market is wired electronically. No, the forex market is just recording the human transactions. Every candlestick you see moving up in the chart means that somebody has bought, or you see a candlestick moving down, it means that somebody has just sold. So every candlestick, every chart you are seeing going up and down is representing a decision that somebody has made. So it sometimes means that somebody has bought somewhere, somebody has sold somewhere, somebody just got panicked, somebody became greedy. It means that somebody has took profit, someone has got stopped out, someone invested, and someone got excited, someone added to his position. So the forex market is just representing what the activity of what has somebody has already done. And it's something that is continuously done every day, every day, every day. 24/7, 5 days a day, the forex market is on, everything is going on. Then imagine a good marketplace. Let's take forex as a huge marketplace where there is buying and selling. If you go there, you will see that people are always charging prices. Somebody is buying, somebody is selling, somebody is paying money, and the transactions keep going more on and on and on. That is how forex work exactly. The only difference between forex and the marketplace you see is that forex is being done electronically, it's being done across the whole world. There's no visible interaction between the buyers and sellers. You just buy according to the price you see it. Then the now auction is that who actually moves the market. There are several participants in the market. Some mistake that we recreators may think that we are the one who is being moving the market, or because we just got stopped out, or because we are becoming fueled in the market. But the market consists of so many people in the market, just like the central banks. These people control monetary policy, and this monetary policy can strengthen or weaken currencies. Examples of these banks include the Federal Reserve, the Bank of England, the European Central Bank, and the Bank of Japan, which they imply the monetary policies. As you can see, most times the central bank hike rates, they cut rates, and in hiking those rates, it can attract more investors. If they are cutting rates, it can make the currency become weak. So these things actually move the market. The central banks makes policy decision. The central bank might decide to raise interest rates, and once they raise interest rate, the the interest higher interest rates bring higher returns for investors. The investors will be more willing to invest in that currency because the currency is likely to appreciate. The interest for investing in that currency have been raised, and if they if they are more willing to invest in a particular currency, they will have to buy the currency. And once the demand for the currency now makes the currency to appreciate, the demand for the currency strengthens the currency, and it makes the cheaper import because if the currency is more higher than the other countries that are likely to export this export goods to the currency, it makes the import more cheaper and makes the export more cheaper. And likewise in vice versa, if they cut interest rate, it will just be the opposite of them. We have the hedge funders. These people are people that are managing a lot of money. Their positions, if they are sold or buy, their positions can influence the market because these people are selling billions and billions of dollars, billions of euros, billions of pounds. It is not like us, we have few thousands or few thousands on the screen. We have another movers of the forex market are the investment funds. So what are the investment funds? In the investment fund, we have the pension funds, the mutual funds, we have the assessment management, we have the sovereign wealth funds, we have the insurance funds. These are people that manage money for both the governments, the companies, and millions of people around the world. So, how does the investment funds influence the forex market? Investment funds analyze the economic data, the interest rate, the future growth of and prospect to decide where to invest. So if they analyze the US GDP, the job, the retail sex, the production rate, and they see that there's a better opportunity in the US, they are more likely to invest in that country's assets. So if they see this better opportunity, they will decide to move a larger amount of money into that country assets. Like if they see a better opportunity in the US, in US, they would like to move to buy US stocks, to buy US bond, or to maybe buy the US real estate. And in buying the US assets, they will have to buy the currency first. So before they could buy the currency, that is where the real forex begins. So these people purchase the US currency in billions. So when they are now purchasing, the demand for the US currency is going to increase. Their massive orders create high demand for the currency in the global market. As demand arises, the value of the currency goes up against the other currency. Like if the US dollar becomes strong because the investment are pulling their money into the US investment, the US assets, the US assets is likely to appreciate because of the demand in the US currency. So if they are moving their currency into the United States, the United States is going to become much stronger among most other currencies like the euro, the Japanese, or even gold. So if they are losing confidence, they sell the currency and move to another country, creating supply and the currency force. So the major key takeaways of this investment fund is that the investment funds control trillions of dollars. Their large currency orders can move the forex market. They influence long-term trends, not just short moves. Traders watch their behavior to understand major direction. We also have the multinational companies. The multinational companies are companies that operate in more than one country. They own and control production, services, or sales in multiple countries outside their home country. So how does these multinational companies influence the forex market? Let's take Toyota as an example. Toyota has factories and suppliers and sales in many countries. It earns revenue in multiple currencies. When the Toyota finish production, they have to export it into different countries for more sales. And where they are selling, Toyota sells cars in mostly the US, the euro, and some other currencies. So when they earn their profit, they earn it in the US or the euro. So let's say assume that the Japanese is the home country of US. So for them to return their sales to Japanese, they have to convert Japanese yen into from US. They have to convert US dollar or euro into the Japanese yen to pay some salary workers and the suppliers of the many, or even some workers. So how does this affect the forex market? It increases the demand for Japanese yen. So to convert foreign currency, they can strengthen the Japanese yen against the US dollar. Another example is the of multinational companies are the Apple company. The Apple company designs in the US, but manufactures in the China and the sales worldwide. So how does that have to do with the forex market? If Apple sells their iPhone in Japan and other countries, they have to convert it into the back to the US dollar where the main company is. And in the conversion of these many currencies to US dollar, they have to buy US dollar with those currencies. It now creates a higher demand for US dollar for converting and earnings. And this can also strengthen the US dollar against other currencies. So when Apple sells more iPhone in euro, it earns more euro, and Apple converts the euro to US dollar and holds US dollar. So the higher demand for US dollar, US can then now strengthen against euro. One important key takeaway is about the multinational companies and how they influence the forex market. So importing goods and services creates demand for foreign currencies. Exporting creates demand for the home currencies. If they are exporting goods and services, they will have to export it in those currency, and if they are importing, they have to import from their own currency. So investment flow. So investing in those foreign currency requires converting the home currency to the local currency, and that is if profit are later earned overseas into the different countries where they are selling their product, they have to move it back to the home currency and send to the parent company where the manufacturing is being made. So companies may borrow in foreign currencies or issue bonds affecting currency supply and demand. So the smallest participants of the forex market are we the retail traders. The forex market is dominated by institutions, banks and corporations, not retail traders. Our job is not to move the market, but we are here to learn and understand the market, the financial institutions, and be able to anticipate how the market goes so that we can be able to trade in the right directions and make money with the big banks. So we traders, we are not here to move the forex market. We are just here to understand the forex market and trade in the direction where the big boys are doing. So now the question comes: if forex exists for business, and why can traders now make money? The answer is simple: because the exchange rates are constantly changing. Suppose today the euro is equals to 1.30 US dollar, and tomorrow the euro becomes 1.35 US dollar. The value has changed. So if you anticipated that change currently, you will make profit from it. As a trader, we are not creating the movement, we are trying to predict it so that when the market goes in our direction, we can be able to make money from it. Then the question now is, why does many people, according to analysis, 90% of people lose money in the forex market? Why does 90% of people lose money in the forex market? 90% of people lose money because they memorize candlestick formation, the indicators, chart patterns, they search for the perfect strategy, but they forgot to ask the most important question: why is price moving? Without understanding the forces behind the price charts and patterns becoming little more than shapes on a screen, you cannot just jump into a screen and analyze history, then use the history to anticipate what is going to happen in the future. It's not possible. So if you don't actually know what forex is, you cannot trade it well. You have to understand what forex is as a beginner, learn basic about forex so that you will know what you are doing in the forex market. We are not here to trade candlesticks. We are here to understand the global market. One important truth about the chart is that let's take chart as the patient's heartbeat on a hospital monitor. The monitor shows what the heartbeat is doing, but it does not make the heartbeat move. But likewise, the forex chart shows what the market is doing. It does not create the market. If you only study the charts, you are studying the symptoms. But to become an exceptional trader, you must also understand the causes of those symptoms. If you go on the chart and start analyzing, marking up your supply and demand zone, you don't know what the forces that are actually making up that demand and supply. So if you are just studying the history, you cannot be able to predict the future very well. You have to understand what is happening in the economy now, why are investors buying, why are investors selling. You have to know what forex really is. so that when you come to the demand, if you are buying in the demand zone, you will know this is actually why I want to buy in this demand zone, because investors are buying, because the US dollar is going to strengthen. So if without aligning your analysis with what the market is reading, you will see that you are just trading with one eye, you are just studying the screen, but you don't know where the market will really move. Actually, three types of participants in the market. There are actually three types of traders in the market. We have the level one, the beginners. So these people, they are only focus on chart patterns, indicators, signals, and entries. What they understand is that price moves because of patterns. When this pattern falls, they believe that this pattern can create this move. What they see chart, they see candles, and they see indicators. These traders are inconsistent because they are easily influenced by one big candle move and the market turns back and take them off. We have another type of trader again. We have the intermediate trader. This one understands how price moves. They understand the zone, they focus on market structure, liquidity, support and resistance, supply, and demand zone risk management. These people actually understand how price moves because of order flow, liquidity, and market structure. They see structure, they see zones, they see liquidity and opportunities. They are more consistent, smart than the beginners. But they make better decisions and understand how the market moves. But sometimes the market condition might change and they lose a lot of money because they don't actually know why the price is moving. And we have the professional stage of the forex trader. These ones are the ones that combine both technical and fundamental analysis. They understand why price moves. They learn the macroeconomy, the central bank liquidity cycles, the geopolitical news, events, and human behavior. They understand that price moves because of the interaction between economies, institutions, liquidity, and psychology. They see the big picture, the money flow, and the market context. So these people are consistent over the long term. They understand the reason why price is moving. So after everything we have explored in this video, I want to leave you with one idea. Forex is far bigger than a chart. Forex is not simply candlestick moving up and down. It is not pressing the buy and sell button. It is certainly not about predicting the next candle. Forex is a global financial system driven by money, businesses, governments, central banks, commercial banks, institutions, investors, and millions of participants making decisions every single day. The chart is simply where the consequence of those decisions become visible. Think of the chart like a heart monitor. A heart monitor does not create a heartbeat. It does not predict what the heart will do next. It simply displays what is happening inside the body. The same principle applies to forex charts. The market moves first. The chart records the movement. And if you truly want to understand forex, you must stop looking at the market as a game of colored candles and start looking at it as a reflection of human behavior, capital flows, economics, expectations, and decision making. That is the foundation. But understanding what forex really means does not automatically make it profitable, because there is another question we must answer. If millions of people enter forex every year, why do so many traders lose money? Is it because the market is so impossible to understand, or is it because institutions are deliberately hunting every retail trader, or is there something much deeper happening inside the trader themselves? In the next video, we are going to investigate one of the most important questions in trading: why 90% of traders lose money. And trust me, this is not going to be another video blaming the market. We are going to break down the real reason traders fail, the mistakes beginners make repeatedly, and the psychological trap that destroy these strategies, and why having a profitable strategy alone is not enough to become a profitable trader. So if you really want to understand this market, not just trade it, make sure you watch the next episode, because now you understand what forex is. It's time to understand why traders fail at it. I will see you in the next video. Please like and subscribe.